Silver just crashed 43% from its all-time high of $121.62, and on March 19th, 2026, the COMEX clearinghouse quietly absorbed 82% of an entire day's silver delivery notices using its own house account. The price is crashing. The institution responsible for delivering the metal is propping up its own market. Think about what I just told you. Subscribe right now, because what I am about to show you is not being covered on any mainstream financial channel. The analysts are debating whether silver hits $50 before it bounces. Nobody is asking the question that actually matters. What happens to the paper price when the paper exchange starts running out of metal to deliver? Let me set the scene for you. Silver spot is trading at $69.55 today, March 24th, 2026. Gold is at $4,418. The gold to silver ratio sits at 63-1. Those are the numbers on the screen. But the numbers underneath the screen, the ones nobody is reading to you, those are the ones that change everything. And what I found when I went through the COMEX warehouse data this week is going to completely reframe how you interpret this crash. Stay with me. Here is what the popular narrative says. A legendary technician named Gareth Soloway, someone I respect, and you may have seen his Kitco interview from this week, says silver needs to fall to $50 to $54 to flush out the weak hands. Gold needs to hit 3,500. Once those weak hands are out, the structural bull market can resume. It is a technically coherent argument. The charts support it, and I am not here to tell you he is wrong about the bounce trade. What I am here to tell you is that this analysis contains a fundamental information gap. It treats the current crash as a healthy correction in a functioning market. But what if the market itself is no longer functioning in the way the chart pattern assumes? Here is the data. In January 2026, a non-major delivery month, historically seeing 1 to 2 million ounces of delivery demand, COMEX processed 49.4 million ounces of silver delivery requests. That is more than 7 times the prior January average, more than 7 times. In December 2025, a major delivery month, 46.6 million ounces were delivered. In January, they nearly matched a major delivery month from a non-major month. This is not normal behavior. This is a run on the bank. Now we are in March 2026, which is COMEX's primary delivery month. By March 19th, a staggering 43.4 million ounces had already been stood for delivery in this single month to date. And here is where the story turns. According to COMEX warehouse data, registered silver inventory, the metal that is officially designated as deliverable, had already fallen to approximately 86 million ounces by the end of February, down 31% from prior months. Some analysts tracking daily warehouse movements believe the effective unencumbered figure, metal with no competing claims, may be considerably lower. If you run those numbers, you are looking at a margin of safety that makes the average bank's reserve ratio look generous by comparison. Let me say that again, so it sinks in. 43 million ounces demanded for delivery, 86 million ounces officially registered as available. That means one delivery month has already consumed more than 50% of the entire theoretical buffer in a single month. And then came March 19th. On that day, the CME house account, the clearinghouse itself, stepped in and stopped 114 out of 138 delivery notices. That is 570,000 ounces. That is 82% of an entire day's delivery flow absorbed by the exchange using its own balance sheet. When the referee becomes the buyer of last resort in its own game, that is not routine logistics. That is the institutional equivalent of a fire alarm. The system that is supposed to be a neutral price discovery mechanism is now quietly patching its own plumbing to prevent a visible failure. If you missed this, you are not alone. This happened 3 days ago and mainstream financial media said nothing. Comment alarm below if this is the first you are hearing about it. Now let me connect this to something Gareth Soloway actually said in his interview, something he said almost in passing that I think is the most important phrase in the entire conversation. He talked about the private credit market. Morgan Stanley and Cliffwater reportedly capping redemptions on private credit funds, a $2 trillion private credit market starting to implode. His exact framing was that this mirrors what was happening in 2008 in the early months of the financial crisis. Credit issues building quietly while oil was rallying toward one SAR, $150. Sound familiar? Brent crude has surged roughly 75% this year, driven by the US-Iran conflict. Private credit is under stress, and the 10-year US Treasury yield equivalent of a 50 basis point rate hike has occurred just since early May. That is not a coincidence. That is the same pattern. Here is what the 2008 parallel actually means for silver. In the third quarter of 2008, silver crashed from approximately $20 to under $9, a 55% collapse. Gold also fell significantly. The mainstream interpretation at the time was identical to what you are hearing today. Weak hands flushed, leverage speculators forced out, paper market volatility normalizing. Every chart technician on every financial channel was drawing their bear flags, and they were right about the short-term price action. They were catastrophically wrong about the structural picture, because in the months that followed that 55% silver crash, the metal began a run that took it from $9 to $49 by April 2011, a 445% move. The forced liquidation was not the story. The forced liquidation was the setup. This is the forced liquidation paradox. The very conditions that are most bullish for silver's long-term case, institutional stress, a private credit crisis, a dollar losing its crisis safe haven premium, geopolitical energy disruption, and now a physical shortage so acute that the exchange itself is becoming its own delivery counterparty. These exact conditions produce the most violent short-term paper price crashes because leverage participants must sell something to meet margin calls. They sell what has liquidity. Silver has liquidity, so silver gets sold. But the physical metal beneath those paper contracts does not disappear. It is accumulated by whoever is standing for delivery, by the institutions and sovereigns and industrial users who are taking actual metal out of the exchange at 43 million ounces per month. Let me give you the industrial picture because this is where the thesis gets undeniable. Global silver supply has been in persistent deficit for 5 consecutive years. The 2026 shortfall is now projected to approach 200 million ounces. Solar panel manufacturers alone require 20 to 30 million ounces annually. The electric vehicle sector consumes 15 to 20 million ounces for electrical components. Silver was officially added to the US critical minerals list in late 25. You do not classify something as a critical mineral when it is abundant. Meanwhile, China has restricted silver exports, reclassifying it as a strategic asset. Shanghai vault inventory has fallen to its lowest level since 2016. Shanghai spot silver has at times traded at a 10% premium over COMEX futures. When the arbitrage between New York and Shanghai breaks down like this, it is not a trading anomaly, it is a geographic supply fracture. The global distribution network for physical silver is under structural strain. Every reference I am citing is in the description below. Now here is the part that connects everything into one picture. Gareth Soloway's $3,500 gold target is predicated on a functioning paper market that correctly reflects physical supply and demand through normal price discovery. His model assumes the machine is working, and the charts tell the truth about what the machine is doing. But what happens to the chart pattern if the machine itself is being propped up? What happens to the bear flag if the entity drawing the support line is secretly buying from itself? Historical precedent, the 1980 Hunt Brothers event, the 2011 Silver Squeeze, Gold's 2020 London delivery crunch, suggests that each of these stress events produced a short-term price suppression followed by an explosive repricing once the physical reality could no longer be obscured by financial engineering. Based on that historical pattern, my analysis suggests that if the COMEX delivery stress is not resolved through some form of extraordinary intervention by end of April 2026, The next leg in silver will not look like a stair-step advance. It will look like the kind of repricing that makes even the most bullish price targets look conservative. If you are a long-term physical silver holder watching your portfolio this week, I need you to hear me say this clearly. The paper price crashing is not the story. The paper price crashing while the exchange delivering the paper is quietly absorbing 82% of its own delivery notices. That is the story. One of those things is temporary. One of those things is structural. Smart money knows the difference. Like this video right now, if that distinction just landed for you, it is the most important thing I have said. Do not make any investment decisions without consulting a qualified financial advisor. This is not financial advice. I am sharing what the data shows so you can make your own informed analysis. Every individual must assess their own circumstances, risk tolerance, and investment objectives. There are 3 types of people watching this video right now. The first type is scared. They are watching their silver position down 30, 40, 50% from the highs, and they are questioning everything. The second type is confused. They have heard the bullish case, they have heard the bearish case, and they do not understand how both can be true at the same time. The third type understands what is actually happening, that the paper price crashing while the physical exchange absorbs its own deliveries is not a contradiction, it is the setup. Which type are you? Tell me in the comments, and comment your realistic silver price target for the next 12 months. I want to see where this community stands. Share this video with one person in your life who owns silver or gold and does not know what a COMEX house account is. They need to see this. Hit subscribe and ring the notification bell, because when this delivery cycle resolves one way or another, you want to be informed the moment it happens. I will see you in the next one.